Welcome to the deep dive. Ever think about the giant companies behind, the stuff you grab every day? Like that Heinz ketchup bottle
Yeah,
or Kraft mac and cheese?
absolutely. They're just staples.
Right. Well, Kraft Heinz, one of the biggest names there, just dropped their Q2 2025 results. And honestly, it's a really fascinating mix. Some strategic moves, a tough environment, and one loss figure that just jumps off the page.
Yeah, that loss is definitely something we need to talk about. Management's trying to frame it, saying, hold on, it's not quite what it seems.
Exactly. So today we're doing a deep dive into those results. We've got the earnings call transcript, the press release.
And our goal really is to cut through all the corporate jargon, pull out what actually matters, and help you understand what's really going on with this huge company. Think of it as your shortcut to being properly informed.
All right, let's get into it. Kicking things off with the headline numbers for Q2 2025. What did they tell us right off the bat?
So overall, the results were pretty much in line with expectations. There was a slight improvement year over year on the top line, which is good. Okay. But net sales did dip a bit, down 1.9%, came in at $6.352 billion versus almost $6.5 billion last year.
And organic net sales?
That was also down 2.0%. So
Yeah.
similar picture there. And then profitability. Adjusted operating income was $1.3 billion. That's down 7.5%. And adjusted EPS earnings per share, which investors watch closely, that was $0.69, down 11.5% from last year. So yeah, sales a little soft, but profits took a bigger hit.
Okay, so those top line numbers, a bit of a mixed bag, like you said. Not a complete disaster, but definitely some pressure.
Right.
But then there's this massive operating income loss, $8.0 billion. The percentage decrease is staggering, over 1,600% down from last year. What happened there?
Yeah, that's the number that makes you blink. It was almost overwhelmingly due to a $9.3 billion non-cash impairment charge.
Non-cash impairment. Okay, break that down. What does that actually mean? Is money flying out the door?
No, not exactly. Think of it more like the value of your house on pager dropping. It's not cash leaving the bank account today. Kraft Heinz has tons of intangible assets, brand names, goodwill, that sort of thing.
Right, the value of the Kraft name, the Heinz name.
Exactly. And because their stock price took a sustained hit, accounting rules basically forced them to say, okay, on paper, these assets aren't worth quite as much as we have them listed. They had to write down the value to reflect the market's view.
So management's saying, look, this is just accounting, doesn't change our view of the company's value, don't worry. But
Yeah.
how much stock should we put in that? Does a hit this big, even non-cash, really mean nothing for the future?
Well, it's true day-to-day operations aren't immediately hit. They can still make catch-up, pay suppliers. But while they put on a brave face, you can't ignore it, a $9.3 billion write-down. That tells you the market is valuing their core assets, their brands, significantly lower than the company does.
Okay, so it's a signal.
It's a big public signal of market skepticism about their long-term value, even if the cash register keeps ringing today. It puts pressure on their valuation.
Right. So beyond the accounting drama, it sounds like they're also looking at some potentially big strategic changes. What's going on there?
Yeah, they're actively evaluating, as they put it, various strategic options. The stated goal is always unlocking long-term shareholder value.
Of course.
And they made sure to emphasize financial discipline, saying anything they do would stick to that. Interestingly, they did have to acknowledge that Wall Street Journal report.
The one about potentially splitting up the business?
That's the one.
Yeah.
They couldn't comment specifically, naturally, but the fact they acknowledged it suggests some serious thinking is happening about the company's structure.
Which brings up that classic concern, right? Is this real value creation or just, financial engineering?
Yeah.
Moving assets around on paper, how are they tackling that perception?
Their message is pretty clear. We're being disciplined, just like you expect, and this is about real, long-term value, not just shuffling things around.
And why are so many big food companies doing this kind of strategic review now? What does it mean for us grabbing stuff off the shelf?
It's a tough market out there for big, established players. Lots of competition from smaller, nimbler brands, pressure to be more efficient, cut costs. So these kinds of moves, maybe spinning off a division, for example, could be about focusing resources better, making parts of the business more attractive to investors. For us, ideally, the products we like stay the same, maybe even get more investment or innovation down the line.
Okay, let's switch gears to that balancing act. Pricing, promotions, inflation, they call themselves consumer-centric. How does that actually play out in their pricing when costs are going up?
Well, they seem to be taking it seriously. They mentioned their pricing in Q2 was up only about 100 basis points. It's just 1% year over year.
Only 1% when inflation's much higher.
Exactly. They specifically said they expect overall inflation for them to be maybe 5% to 7% this year.
Hmm.
So pricing way below that really does back up that keeping the consumer in mind idea. In fact, they pointed out that in North America, if you strip out the cost inflation pass-through, their actual pricing decisions were negative. They're absorbing a lot of the cost pressure.
Wow. That sounds noble almost, but also risky for their margins, right? How do they manage that? Are they cutting back elsewhere, like on marketing?
It's definitely a squeeze, yeah. Long term, you have to offset that somewhere. But marketing? Nope. Completely the opposite. They're actually increasing marketing spend significantly, adding another 30 basis points. They're aiming for 4.8% of net sales by the end of 2025.
4.8%. How does that compare?
That'll be their highest level in almost 10 years. So a big bet on brand building.
Interesting timing, too.
Yeah, a lot of that spending is weighted towards the second half of the year, especially Q3, hitting key periods like summer, backing new product launches, renovations.
Okay.
There was also a little timing shift, they mentioned, some inflation and promotion costs moving from Q2 to Q3 because of inventory stuff. About a 30, 40 basis point impact, just a technical thing.
Got it. So investing more in marketing, but what about the actual costs? Is inflation still raging for them? And what's the latest on tariffs?
Okay, commodities. Good news there, actually. Costs apparently peaked in Q2. Some of the P&L impact gets recognized in Q3, but they expect real relief in Q4.
Any specific hotspots?
They call out cheese and coffee as still being particularly high.
Ah, okay. And tariffs.
Tariffs are definitely a headwind, looking like about a 100 basis point impact this year. And they warned, if those tariffs stick around into 2026, the full year hit could be more like 180 basis points.
Ouch.
Yeah. They said they're working hard to mitigate it, finding efficiencies, but they also admitted some pricing might be needed if those tariffs stay put.
It really is a juggling act, isn't it? Trying to absorb costs, keep prices reasonable for us, but also deal with things like tariffs and invest in marketing. So the big question for people listening, what does this likely mean for the price of their Kraft mac and cheese or Heinz beans going forward?
Well, based on what they're saying, you probably won't see sudden, massive price jumps across the board. Their strategy seems to be invest in the brand, improve the product, make you feel it's worth the price, even if it creeps up a tiny bit.
Justify the value.
Exactly. Justify the value rather than just hiking prices because costs went up. It's about holding on to market share and loyalty in a tough spot.
Okay, let's talk growth. Where are they actually putting their money and effort to grow the business? They mention a multi-pillar strategy.
Right. They're pretty consistent on this. The focus is on investing to grow across three main areas: emerging markets, North America retail, and what they call away from home, like restaurants, food service.
And they're investing across the board.
Yeah, things like making products better, improving manufacturing, upgrading their systems, foundational stuff.
Now, emerging markets sounded like a real bright spot. Tell us more about that.
Oh, definitely. Emerging markets is performing really well. Top line grew around 8%, and that was from both price and volume, which is key. And even better, their margins expanded substantially. They hit their highest ever operating income margin in that segment. It's already a $2.5 billion business for them.
Wow.
And they sound super confident about hitting double-digit growth there long term.
What's driving that success?
Seems to be a combination of things. A simpler portfolio focused on what they call taste elevation, think sauces, condiments. The Heinz brand itself grew about 18% year over year there.
Strong.
And they have a go-to-market model they say is strong and repeatable. They're basically taking what works and expanding it across Latin America, the Middle East, Africa, Asia.
That's a great story. But back home, North America retail. That's where most of us buy their stuff. Sales were down overall there, right? What's the nuance?
You're right. The overall number was down. But here's the crucial detail. They said if you exclude cold cuts and bacon, which were big drags, apparently driving like 40% of the decline.
40%. Just those two.
Yeah. Seems like those categories are really tough right now. But if you take them out, the rest of the North America retail business is actually showing significant improvement.
How much improvement?
Well, in the latest 4 weeks before the call, excluding those, sales were down 2.7%, which sounds bad, but it's much better than the year-to-date figure, which was down 4%. So things are trending slowly in the right direction for the bulk of the portfolio.
Okay, so some green shoots there. And away from home.
For away from home, it's mostly about expanding distribution. getting their products into more places and pushing new innovation for food service customers.
Now, how are they making these improvements happen across the board? They talked about this brand growth system. What is that exactly?
Right. The brand growth system, it's basically their internal framework, a structured approach to making their brands better. It involves investing systematically in product superiority.
Making the product itself better tasting or better quality.
Exactly. Plus, better, more effective marketing and using e-commerce tools more smartly. It's a repeatable playbook they can apply to different brands.
And are they using it much yet?
They're scaling it up. Last year, it only affected about 10% of the business. By the end of this year, they expect it to touch about 40%. And they're focusing it disproportionately on North America, on the brands they think have the most upside. They're about the accelerate platforms.
They gave Capri Sun as an example, right? How did that work in practice?
Yeah, Capri Sun is a perfect example. They applied the system, reformulated the product, ramped up the marketing. They mentioned a Nintendo partnership.
Ah, clever.
Yeah. Highlighted the benefits, no artificial flavors, better taste. And crucially, they expanded it into new formats and channels, like creating a bottled version for club stores and single-serve sales.
So it's renovation, marketing, and distribution all working together.
Precisely. It shows how the system can deliver tangible results you can actually see and taste.
It sounds like a focus on strengthening what they already have rather than just chasing novelty. What about innovation, though? They admitted they fell behind during the pandemic chaos.
They did. They were pretty candid about being low on innovation, partly due to focusing on just keeping supply chains running.
Understandable back then.
Yeah. But they made progress. Innovation was only 1.6% of sales in 2022. They got that up to about 3% by the end of last year, 2024, and they plan to keep investing.
Are there specific examples of recent innovation working?
Definitely. That Taco Bell at home range. Second year of double-digit growth, and they're expanding it into Canada now.
Oh, yeah, I've seen that.
And Heinz itself is moving into new areas, like pasta sauce in Europe and Latin America.
Yeah.
Plus, growing their Heinz mayo business internationally. So, it's happening.
So for people listening, what does this focus on brand growth and this kind of targeted innovation mean for the classic brands they grew up with? And what new things might actually show up?
It probably means you won't see Kraft Heinz suddenly launching, like, artisanal cricket protein bars.
Uh-huh. Probably not.
No, they're doubling down on the icons. So expect better versions of the classics like the Capri Sun example. Maybe new flavors or formats for things like mac and cheese or Heinz beans, and extensions that make sense. Heinz moving into related sauces. It's about making the familiar better, more relevant, and giving it more staying power.
Okay, looking ahead then. Despite all the challenges, Kraft Heinz reaffirmed their full year 2025 outlook. What are they actually telling us to expect for the rest of the year? Lay out the key points.
All right, the outlook for 2025, organic net sales, expected down 1.5% to 3.5% year over year. So still anticipating a slight decline.
Okay.
Constant currency adjusted operating income, projected down 5% to 10%. And that includes about 150 basis point headwind because of how variable pay was accounted for last year. So a chunk of that drop is technical.
Got it. Margin.
Adjusted gross profit margin, now expected at the lower end of their previous range, so down 25 to 75 basis points, reflects those cost pressures we talked about.
And earnings per share.
Adjusted EPS forecast in the range of $2.51 to $2.67. There's also a note about the tax rate being around 26%, which includes about a double 23-cent hit compared to last year because of new global minimum tax rules.
Okay, lots of moving parts there. And cash flow.
Importantly, free cash flow is expected to be flat compared to last year, and free cash flow conversion, how well they turn profit into actual cash, should be at least 95%, which is pretty strong.
So, given the headwinds, the impairment charge, why do they sound relatively confident reaffirming this outlook? Where's that confidence coming from?
It really seems to stem from everything we've just discussed. They believe those investments, the brand growth system, the bigger marketing push, the focus on e-commerce, plus their financial discipline are starting to gain traction.
You think the strategy is working?
They believe it will drive improvements, especially in the second half of the year. They're betting on their plan.
So, if we're watching Kraft Heinz over the next few quarters, what are the key things you'd look for to see if that confidence is justified? What are the signs the strategy is actually paying off?
I'd watch a few specific things closely. First, that organic net sales trend in North America retail, excluding cold cuts and bacon. Does that gradual improvement actually continue and maybe even turn positive?
Okay, the core portfolio trend.
Exactly. Second, emerging markets growth. Can they really deliver on that double-digit promise consistently? That's a huge part of their future growth story.
Right.
And third, adjusted gross profit margin. Can they manage inflation, tariffs, and the increased investment without margins eroding too much further? Those three, for me, are the crucial indicators.
Okay, so let's sum up this deep dive. Kraft Heinz is navigating some pretty tricky financial waters, clearly. There's that huge non-cash impairment, which management insists doesn't change the underlying value.
Right, a big accounting event, but they say the strategy holds.
And that strategy involves a fierce focus on their core brands, using this brand growth system, significantly boosting marketing, and innovating smartly around their established names, all while dealing with inflation and other market pressures.
It's a complex picture, definitely. Balancing cost pressures with long-term brand building.
Which leaves us with a final thought, and maybe something provocative. Kraft Heinz is putting so much energy into making existing products better, expanding core brands like Heinz globally.
Yeah, doubling down on the familiar.
Exactly. In a world that seems obsessed with the next big thing, what does this focus on proven, even nostalgic brands tell us? Maybe about the future of the food industry, or perhaps the enduring power of those brands we grew up with. Something to think about next time you're in the pantry reaching for a snack.